So we're going to talk about multifamily, but we're also going to talk about variables that may impact the value, the income, the supply. We're going to talk about unemployment. We're going to talk about inventory rising. We're just going to talk about all things multifamily because I think there's a lot of noise in the market. We're going to talk about one of the professionals, Mr. Jonathan Twomley. How you doing, sir?
I'm doing great, Michael. How are you?
I'm doing well. So let's talk about unemployment. It is Thursday when we record this. We just got the weekly unemployment claims. I think they came in at roughly 240,000, slightly above expectations, but probably nothing to be currently worried about. Latest unemployment read was 3.6. So not currently a problem, but I'm sure you see the talking heads or the folks that probably own no assets saying that unemployment's going to spike and going to crush housing and crush multifamily. I am curious, what do you think about that? What do you think about rising unemployment being to the detriment of multifamily?
Are you asking me, is rising unemployment a problem for multifamily as a general matter? Or are you asking me
Yeah,
what I think is going to happen?
I'm asking you, do you see unemployment spiking, you personally, unemployment spiking over the next however long you want to call it, crushing the values of multifamily?
So listen, I'll be honest with you. I'm sort of agnostic on whether it's going to happen or not. I mean, they keep on telling us it's going to happen. It hasn't happened. Maybe we're getting a soft landing. I don't know. I mean, I've given up trying to predict these things.
Yeah.
And we could well be in a situation where, interest rates were kept artificially low for too long because the Fed was scared and it turned out there was nothing for it to be scared about, and interest rates goes up and everybody's fine. Who knows? I don't know. I have no crystal ball. Okay. However, let's just assume that unemployment does go up.
Okay.
And if it does, then, and obviously everything is local, right? So if it goes up where your asset is, this is absolutely a problem for you. I mean, it really depends on the degree of unemployment going up, et cetera. But it is not, jobs are what makes rents go round, right? And if there are fewer jobs, there's less money out there, and people are going to be less willing to pay, rent.
I got a question for you. You've owned multifamily assets for quite a while. Just roughly speaking, what was unemployment when you were buying assets? It was because when I was doing
it was still
like
higher.
6%.
Yeah, I mean, unemployment when I was buying my first multifamily in South Carolina, this was after the Carolinas took quite a while to recover fully from the great financial crisis, right? So if I'm correct, I think unemployment was still around 7 or maybe even 8% when I was buying, right? And so, but occupancies were still strong. People were still.
That's where I wanted to go, right?
Because
people have very, recency bias.
Yes.
I've operated in a world where Fresno unemployment has traditionally been double digits.
Yeah.
10, 11%. And, occupancy debt collection, we know how to work through that. Now, could we get there? Sorry, new house smell. But I don't think a lot of people realize, we're at 3.6 today. I think Fresno's at 8, which may sound high, but again, we're historically at 11. If we go from 8 in Fresno to 9.5, we know how to operate there. I think people are just screaming unemployment's going to destroy everything, not realizing that there's a lot of buffer in there to get back to kind of normal.
Yeah, I think the issue is if the current rents that people are getting are, if that unemployment, the low unemployment right now is baked into that number, right? So if the low unemployment is what's causing all of the rent increases that we've seen,
right, then
the tide is also going to go out, right?
That makes sense.
And it really depends on the degree of it. But I think, I would be frankly scared if my unemployment rate tripled in my market, right? You're saying if it goes from 3 to 9, right? I mean,
that'd be a problem.
Yeah, that would be it.
But is 3 to 4.5 a problem?
Probably not. I don't. Exactly. That is probably not a problem because if you're already in an undersupplied situation, you're probably okay. Now, but rents could soften, right? So maybe you're not going to get rent increases, right? Except when you're really like doing a value add and you're changing the character of the apartment, or if you find a building where rents are artificially low, even in that market. And those deals are out there, right? I mean, there are
Sure.
those landlords out there who just don't raise rents for whatever reason. So in those situations, you can do a big rent bump, right? Because you're just bringing it to what the market is. But I think where you see if unemployment is an issue, where you see it is in your inability to push rents on renewals, right? And so, and you may find that you've got more vacancy because now people have more options, right? Because maybe vacancy has spiked up a little bit. And this is happening in some markets already, but this has nothing to do with unemployment. It has to do with supply and demand.
That's
Some
where I wanted
markets
to
are,
go. That's where I
yeah,
wanted to go to next. So again, the other thing I hear about multifamily is all this this new inventory, the shiny new stuff is coming. Now, again, I'm not in that world. You are. It does seem to be very local. Like there are some cities where there seems to be a lot of these new things coming, but that's not a national story, I don't
exactly.
think.
Yeah, it's not a national story, and it really depends on what market you're in, right? So if you look at some of the latest data that's come out so I think Yardi Matrix, they do a report every month. They just brought out their most recent report, and like rents in New York City were up 5%, 5.5%,
I
right?
saw Manhattan just had another record at like 55.46 or something. Just
Yeah,
wild to think
and
about.
like surprising to me, actually, the best rent growth was in northern New Jersey, where people are, I guess, because they're moving, they leave Manhattan, go to the suburbs, and then there's very little supply because you can't build anything out there, right? It's all single family zone, so there's not much multifamily, and the occupancy rate is like 98.7% or something
Wow.
crazy, right, across the market. And so they had really strong rent growth. But you've got markets like a lot of the superstar markets over the last few years, like Austin and Phoenix, they've actually had rent declines because so
Yeah.
much new supply has come on, and it all, it comes out, and it's really disproportionate at the top level, right? So you don't necessarily see the rent declines lower down, right? But you do see the rent declines at the top where there's just, an increasing supply competing for a growing market, but it's not growing as fast as the supply, and it'll take some
Mhm.
time for absorption to happen. So, that's where you're seeing it, but it's definitely not a like countrywide phenomenon. I think rent, at least half the markets, I believe, in the latest survey had increasing rents, and
Yeah.
some were flat, and some were losing rents, slightly. But that's again on
Yeah.
an average, right? I mean,
Yeah.
that's even sort of neighborhood specific and asset class specific. So you may be losing, it may be class A is where disproportionately there's a lot of negative rent growth. But if you go down to class B, class C, where there's no new supply, then you're not seeing the negative rent growth. So, however, just to back up to the unemployment question again, if there is a spike in unemployment, where you're going to see it hit hardest is class C,
Yeah.
right? Because class C is where disproportionately those are the frontline workers who are the first to get fired and the last to get rehired, and also where people have the least amount of cushion if they do get laid off. So that's where you'll see your delinquencies rising, vacancies rising, evictions rising, whereas the B and the A will be relatively stable if unemployment spikes, right? So obviously it's like there will be some impact, but there won't be the kind of impact that you see at class C. So it
Yeah.
really depends on on the supply side, A is the problem. On the demand side, C is the problem.
Yeah, the other thing to kind of round out this discussion that I'm seeing is, again, we're seeing mortgage rates in the residential space stay above 7%, which
Yeah.
is causing record affordability problems. The longer that affordability stays this stretch, I have to assume that it helps multifamily rentals because people make that, buy versus rent decision. And in a lot of the country, if not most of the country, it's frankly more affordable to rent than own.
Yeah.
And I think the longer we stay above 7, I think that trend continues.
Well, you don't think prices will adjust downwards though? I mean, naturally, once you
No,
see,
I mean, in single families,
yeah.
we've essentially taken the demand and supply curve and taken it down from 6.2 million transactions to 4 million.
Hmm.
That's an entirely different picture. If you told me we were going to do 6 million transactions this year, yeah, price has to come down, but we don't have to do 6 million.
Right.
Again, I tell people to go get my 53-year spreadsheet. I think people are shocked, and you may be shocked. We'll play the game here. So 1978, We do roughly, I think, 4.6 million transactions. Then the Fed starts raising rates. They raise rates essentially for the next 4 or 5 years. Guess how long it took for transactions to get back to 4.6 million?
10 years.
Yeah, 12 years.
12
Most
years.
people guess
Wow.
4 or 5. So again, we're in for a slow grind sideways. Fannie Mae CEO just said that. Goldman Sachs is saying it now. It's going to be years of sideways. It's what it says in the charts. So yeah, we just took the supply curve and talked it down, the demand curve and took it down. So no, I don't think prices crash. I don't think price is correct. I think we're sideways for 3 to 5 years. Now again, places like Austin or Salt Lake, very regional stuff, will have problems, no doubt. But I talk about two things: Fresno and Nashville, right? If you know your buy box in your area. But yeah, I don't see prices coming down. Even if unemployment went from like 3.6 to 5%, prices aren't coming down. There's nothing for sale. In fact, there was a Houston broker I talked about on the Daily Financial News that built a chart that summarized my opinion to the penny. He took Houston zip codes down the left, and he took price points across the top, 6 categories, right? From basically cheap to luxury. And then he put a heat map. It is scorching red below the median and ice cold in luxury. It's exactly what I've been telling folks. And again, in a market like that, it's going to keep the median price where it is.
Yeah, interesting.
So
it's funny. I see something similar in upstate New York, where I'm not looking to buy anything, but I just sort of like to look and see what's happening there. And what I've noticed is that anything that's below the median, and this is a small market with, a population that is flat, if not declining, anything below the median is sold almost immediately.
Yeah.
Almost immediately. Yeah.
And again, that's not a recipe for declining prices. It's just not. Now, again, if you happen to be in the luxury market, like, some of the folks that follow my channel, you can get amazing deals. Somebody that follows my channel, shout out Tammy. She's been tracking a luxury home, ultra luxury. Let's be clear, ultra luxury home for a year now. Finally got the seller to capitulate on price and have 2 lots thrown in. So now she's got not only a 1 acre ultra luxury, but a 2 acre ultra luxury property. So again, the deal, if you want a deal, it's going to be ultra luxury. And that's just where we are, right? That stuff's not selling. Rates are high. People are cash buyers, move quick. It's just, it's a great time to be shopping for luxury and ultra luxury, I think.
Awesome.
Yeah. So Jonathan, where can people find you?
Oh. Yeah, come and join me in my Facebook group at Apartment Investors Club, or at apartmentinvestorsclub.com if you'd like to get on my email list. And if you'd like to invest with me, come to Two Bridges Asset Management LLC. Just Google us and we pop right up. Lots of people have come over, by the way, from this channel. So I'm really grateful to you, Michael. We get several people a week coming over and signing up. So if you guys are interested in getting in on my deals, come on in.
There you go. Thank you, buddy.